Thank you for joining me on Connected. Today we're having an interesting discussion about M&A in the industry of iGaming. And no better could I have as a guest today than my good friend Crispin Nebor of TechCorp Capital. They specialize in supporting entrepreneurs on the buy side or the sell side of much of today's M&A activity. And today we're talking about not just what TechCorp does and how they look at a deal and how they advise operators and founders in their businesses, but how you can build value in your business toward that future deal, and how investors are looking at the different landscape of today's market with emerging products like sweepstakes and polymarket type prediction betting, how they're looking at the regulatory changes and how the companies have navigated moving from unregulated markets into regulated markets. Take Brazil, let's look at Canada. We talk about all these things, and we also come up with some really good pointers for those of you that are running a business that is either planning for a capital raise, planning for a strategic buy or sell transaction. Crispin has seen the landscape through the lens of an M&A advisory, talking with some of the leading founders and leading executive teams in today's industry. And I think you're going to enjoy this conversation. I know I did, and I'm grateful for Crispin's insights. Join me, will you? It's so great to see you again. Thank you for joining us today.
Great to be here, Ashley.
Yeah.
Thanks for inviting me.
So Crispin, people have all kinds of ambitions when they set out in this industry and business. Every entrepreneur has a plan for a future exit. There's so much road to travel along the way. Challenges at the beginning, struggles in the middle sometimes in finding the capital you need at the growth phase in the business.
Yeah.
And then ultimately the prize, the exit, and successfully navigating that. You've done it all. So there's a lot for us to talk about. I look forward to unpacking various stages in that journey and how
Sure.
at TechCorp you guys specialize in focusing on supporting companies that entire journey. So maybe let's start there. Tell me about TechCorp Capital, what you do for the companies that you advise,
Yeah.
and where your sweet spot is.
Thanks, Ashley. So, I'm a partner at TechCorp, and we specialize in advising companies in the global gambling sector, mostly online, but also sometimes retail, on M&A and corporate development. And what that means is we often advise entrepreneurs, early stage businesses, sometimes mid stage, on selling.
Mm-hmm.
We might get involved with a company before it's ready to sell. We might help them think about how to prepare for that sale, how to structure their business differently, how to think about building different elements of their revenue or their cost structure. So we help on the sell side, and we'd like to build long-term relationships. And then we also, we help on the sell side. We also like to work on the buy side. We advise some of the biggest operators in the industry on finding attractive targets. It might be to help them do new market entry. It might be entering different verticals. It might be filling in a missing piece in their tech stack. It might be to help them drive their marketing. It could be a number of areas. So we help on both. Sometimes we also don't just help on a deal. Sometimes we help people think about their strategy. So some of the larger organizations, they often like us to help them think about what are their options, both organically and through M&A, on whether that's by territory or by product. So we also provide consulting services to some of the larger operators.
It's interesting that you say that, because I would think the first thought comes to mind when there's a transaction pending, when you're either decided you're looking to acquire as a method of growing the business, or you've taken the business to a valuation point where a sale may be attractive. But it sounds like they should be talking with you sooner.
It's really interesting you say that, because when I ran my own business, my own poker business for 9-10 years, I have my own experience of this, is that when things are going really well, the last thing people think of is selling. They think, look, and the investors and the founders together, if there are investors separate to the founder, because they all think, sky's the limit, and nothing can go wrong. The best time to sell is when you've got a very strong future growth story. And in our world, as we'll come on to, I'm sure, our biggest unknown is regulation. And if you don't have a diversified customer base, then you're at risk from single or maybe dual market exposure and concentration. And so I always say to people, you ought to be started to think about selling much, much earlier than you would normally admit. Because when we get into businesses, we can come onto this, you'd be amazed by the things that stop a transaction happening. And it's not usually price. It's not usually your cohorts and your CAC LTV, it's usually something totally unexpected. Like maybe you base yourself in Gibraltar, but you made all your strategic decisions in the UK. Maybe you've got a massive tax liability you never dreamed of, which is going to kill the valuation. Maybe your compliance team and infrastructure is not set up right, and you've got a bit of exposure. Maybe maybe there's a specific market you're in, which is you've put too much investment in, and it's about to head south.
Right.
So these are the areas, and CEOs tend to be massively overstretched and thinking about the core business, how they're going to grow it in the next 3-4 months. They're not thinking about how an investor's going to look at it when they come in.
Is part of your role aligning the investors with the founder? Because the founder may not be fixated on an exit, maybe thinking about the product vision and market dominance, but the investors want to know that there's a 5-year return or there's an end in sight. How do you provoke a healthy discussion at an early stage in a business to make sure there's alignment? Because otherwise founders can be forced towards an early exit that seems premature and it distracts them from the product vision. Or alternatively, investors may be held to an unforeseeable exit, not being able to chart when that might happen.
Yeah, I mean, alignment on founders and investors is a really interesting area. It works best, obviously, when the founder's got a big chunk of equity.
Right.
And when he makes money, the investors make money. It's much harder when there's a split, when they have a smaller percentage, they're more thinking about salaries. Sometimes you get divergence of interests. But specifically on your point, which I think is a really important one, particularly early mid-stage businesses, I think the way to think about it is when a founder is starting out a business, the alignment from a people perspective is absolutely crucial. When founders are picking their investors, and it's the same when you come to sell, actually, and we'll come on to that. When you're picking investors, you need to be absolutely certain that your and their intentions and your and their assumptions about the business are aligned. That's when it all goes wrong. People say it's the people stupid. Invariably it is. If you have a good relationship and you understand that an investor is basically seeing this as a high risk bet, a medium risk bet, a low risk bet, understand what the positioning is, understand what their timeline is, and try and avoid taking money too early and setting in valuations too soon when you haven't proven yourself. We can talk about this, but doing things in a staged way, taking the right type of capital at the right time, creating those milestones, owning the narrative, building the milestones around things like scarcity, not just profitability, putting it around, once you've proven your cohorts, for instance, once you've got market entry. These are the things, and then you can go back to your investors and say, see, I've achieved what I said I want to achieve. Now I get phase 2, phase 3. That's the smart way to do it. Having a big chunk up front often goes wrong.
So, when we say businesses in this sector, there's B2B and there's B2C, and there may be different strategies or different valuation mechanics that contribute to valuation in either of those businesses or strategies to build value.
Yeah.
So maybe it's a generic question, but what are the primary factors that help build value in this industry?
So if we talk about B2C, first of all, because B2B's about owning the economics. And you'll know this better than anyone, actually, in your world. But in B2B, just briefly, it's about owning the economics. If the average operator is paying, say, between 5 and 30% for a service, for the B2B operator, building value is about taking a bigger and bigger share of those economics. And that might be through acquiring a particular set of new customers, increasing your loyalty, but increasing the share of wallet you have through them. The B2C side is much more nuanced. And it starts with regulation. And initially, all buyers start, the kind of key driver above all is getting access to customers. Because in markets like the US, extreme example, $300 to maybe $1,000 to acquire a customer. So it can be much cheaper at a kind of very rudimentary level when first start thinking about M&A to get customers through an acquisition. And it's one of the ways sometimes valuations are done. But when investors are thinking about buying a business, they're thinking, what access does it have to which regulated markets? Is there scarcity? I.e., in most regulated markets, it's tough to drive a profit because of the tax, because of the headwinds. So they have maybe a strong position, good market share, podium position, maybe top 4 in a regulated market. The second point on regs, though, is what is the direction of travel for that market? We've seen what's happened in the UK, and it's gone from being the sort of darling of the industry to something that's extremely challenging. So that's absolutely key now for investors. There is no expectation of things continuing as there are. And the third point on regs with regards value for these businesses, when they come to look at them, they're much more interested now in the compliance function. If you haven't got your infrastructure set up right, if you look a bit fast and loose, it's a massive turn off very quickly. So if you're running your business early stage and you're just basically keeping the right side of things, be very careful because things come up later. You want to appear blue chip, whiter than white.
Because in an acquisition, they inherit those skeletons that were in the closet from...
And a problem in subsidiary 9 is a big problem for parent 1.
Right.
And so, you're only as good as your sort of worst off subsidiary in terms of compliance. So that's really important. And it's something that smaller businesses miss. So outside regulation, the other area to think about is quality of earnings. It's a sort of, a bit of a pompous word, but basically what it means is when the buyer looks at your revenues, how volatile are they? How sustainable are they? And what are they based on? Are you heavily reliant on big affiliates who are SEO led? Are you reliant on big VIPs? Are you very heavy on bonusing? Or are you at the recreational end of the spectrum where players are spending small amounts for long periods of time? There's more longevity. And that's what the regulators want. That's, funnily enough, of course, what the investors want. And you look at the deal that Flutter did buying Tombola in 2022 for 500 million. Bang on, right? They've gone for an element of the customer base, which is, from an investor point of view, long term. So people are thinking about quality of earnings. And the last two I'd mention when you're thinking about your business and how set up you are for sale would be sort of tech and brand together. How much of that do you own? That's important. That can actually drive up your multiple. And the last one, but maybe one of the most important, is optionality. What is your growth prospects? We talked about the best time to sell is when you've got great future growth. Is this business set up to grow in its existing silo? Or is it able, because of the assets it's built and the experience and knowledge, to go into a different vertical, a different geographical state, and expand that way? And that's what investors really love. You don't have to have proven it all. You just have to have shown that you've got what it takes to be a success in those other areas.
So if I can recap that a bit, so it sounds like one of the primary factors you see as a driver is regulation, and so regulated markets, the direction of travel across the globe.
Yeah.
But there's markets, let's roll back a little bit in Brazil, where there was some attractive targets that had built businesses in an unregulated way in the Brazilian market, established market share and built a brand.
Yeah.
That were then attractive targets when regulation was coming for foreign operators to come in and enter the market.
Exactly.
So was that a strategy that would have been predicted from the onset in those businesses, or was that an opportunistic view at a transition and point in?
Great question. Yeah, great question. There comes a point, the way regulation unfolds in our market, you'll know this actually, is that you tend to get quite a lot of foresight. You tend to get a feel for where it's heading maybe 2-3 years before it goes live. I mean, look at Finland. Finland's due to go live with new licenses next year, but the actual basis of that and the remote gaming duty tax rate, which I think is 21 or 25%, was set out a year or two ago. People knew 3-4 years before it goes live that it was going to be a solid bet. With Brazil, whether it's serendipity or coincidence for some of those players, who knows? But the real stars of the show are people who didn't really care. They were out to build the best possible product for that particular localized customer group and offer the most competitive positioning and create the best ROI out of their customer base. And so my colleagues at TechCore did a great deal selling the kind of local market champion NSX to Flutter, which fulfills that exact category. But those deals aren't easy, because the challenge for someone like Flutter, global quoted public company with a very strict, rigorous approach to M&A, when they first embark on this type of approach, you can imagine that a business like NSX, it's an unregulated market. It's focused on growth. When it comes to all of the items to do with audit and all the checks that need to be done, it's a long journey. So
But I guess a group like Flutter can bring that to the table.
they can, and they are particularly good acquirers. And if you look at Flutter, it's easy to forget that Flutter was originally Paddy Power, and then Paddy Power Betfair, and then I think through 11 acquisitions since that date, they've become $18.5 billion market cap. It's an M&A it's a legendary story in M&A in the gambling sector. But along the way, you need a really, really smart team that's able to cope with buying businesses that are quite unstructured and informal in Brazil, and then buying businesses that are quoted or unquoted in Central Eastern Europe, US. And that's a talent. And we see lots of different buying communities, and I have to say they're one of the best, because you need to basically be pragmatic and evolve and adjust to the situation.
Would you advise a founder of an early stage business to start a courtship with a potential buyer down the road and establish a relationship with a strong acquirer like Flutter Group at an earlier stage?
Yeah, I think it's really
even
important.
if they're not ready for a deal yet?
Totally. I think when you're setting up your business, it's important to think who your buyer's going to be. I mean, the problem, and you want as wide a field of potential buyers as possible. As we know, price is driven by market forces. If there's only one buyer, they got the power. And in the world of crypto, maybe unregulated markets, there are far, far, far fewer buyers. In the regulated world, there are many more. And it might be that they're consolidating in a market they're already in, or it might be they're expanding into a market they're not in. But definitely think like that. Now, courtship's hard because as an operator, you want to focus on what you're doing and focus on that above all else. And it should never matter to you whether you sell or not, because you are building a business of great value, of great integrity, and a business that you love. That's the important thing. But on the way, you need to be keeping an eye on, if exit is important to you and your investors at some point, you need to think who your buyers are.
So you brought up crypto, which is an interesting one for me, because from Pragmatic Solutions, we have the vast majority of the work that we're doing these days relates to regulation and compliance and supporting operators and expanding into regulated markets. But when I leave the office and I'm a consumer out there in the wild, I am bombarded with brands that exist outside of that space that are in the crypto world and have global brands that seem to operate in a different model. Let's say. How do they create value? Are they creating value? Are they attractive to potential acquirers? Is there a business to be bought there, or is it an opportunistic strategy that doesn't have the same future outlook that you'd see in a regulated market business?
So, great question. I think with crypto, in terms of enterprise value, it does have enterprise value, but it is highly conditional. And it's usually very discounted. And I'll explain what I mean by that. So crypto sites are very attractive on the one hand. If you think about them, they're global. They've got global customer bases. They're not held up by regulatory country by country or state by state limits. They're usually very, very good at UX. They're very slick. They're very fast. Their payments are brilliant. And they also tend to have young user bases. The kind of user base that everyone would love. So on paper,
which relates to the first point about being good at UX and innovation.
Exactly.
Yeah, more attractive to.
So they have a lot of the elements, right? But the problem is they are unregulated. They have their customer base has been built with no AML, anti-money laundering, no KYC, no source of funds checks usually, and there may be some, but it won't be anything like the regulated market has to do. And as a result, the investor group is tiny. The number of people who would want to buy it is extremely small. And that massively drives down price, because the buyer is basically also thinking about this could get outlawed. I mean, all you need is one of these crypto sites to lose a banking relationship. And then the customers coming in can't convert from fiat to crypto. And the model's gone. So it's incredibly risky. So you've got this huge amount of cash coming in. So a buyer's always going to take a view, is that cash flow going to be there next year, year after? So that's the view that they're taking. What I think is really interesting at the moment is you see businesses in crypto, and we can come on to this with the other innovative models that are happening, starting to think about moving into regulated.
Right.
Because as I said, they've got they've got cash flow, they've got brilliant capability in technology, brilliant capability in marketing. They know how to manage customer bases. And I don't know if you saw, but Stake had done 2 interesting small moves recently. They acquired licensed entities in Italy in 2024, I think, and Finland last year, and Denmark last year, and they've just gone live in Denmark this year, regulated. So Italy and Denmark for Stake, both live. Now it's smallish, but I think it's a really interesting new phenomenon where you're seeing people bridge the gap. They've built a brand, they've built know-how, they've built tech, built teams, and now they're applying that. And so in this new market, much higher multiples.
It's interesting. You and I both have had time in the B2C space with some of the leading brands.
Yeah.
Historically in this industry. I spent some time with Bet365. You were with William Hill.
Yeah.
I remember thinking these brands are never displaceable from the position they have in the market in terms of brand recognition. And then you see a strategy like Stake has done, and now moving towards bringing that brand into regulated markets one by one. Is that a strategy? Is that, you can't argue it hasn't been effective in building a global brand. I guess the test now will be, can they navigate into a stable position of long-term value by having eligibility to participate in markets that are locally regulated?
Exactly.
Yeah.
I think that's exactly right. The one thing I should have mentioned, obviously, is they're just huge cash flow businesses.
Right.
Very high margin in comparison. 365, William Hill businesses, we are, lowish margin businesses. So we'll have to see. But I think the timing is quite smart from Stake. They've obviously got a view about where crypto's going, and they're hedging their bets.
No, it's really interesting, and succeeded in building a tremendous global brand on the back of their early foray with crypto. But you mentioned something earlier that sticks out in my mind too, because I've observed the same thing. These crypto first brands do such a great job of innovation on the customer UI UX.
Yeah.
Why weren't the established operators in front of that?
It's a great question. And, occasionally they do. But sometimes, and we could talk about this, one of the challenges of M&A is that some of these great little businesses get bought up. And then if they're not structured right into the business, if, for instance, you go for a heavily centralized model and you're sucking out costs and you're, some of that real entrepreneurial flair and some of the great bits of those businesses can get lost in the bigger beast. Sometimes a more decentralized model can really help if you have more of a private equity approach.
Right.
So the hands off, like, here's some APIs, you can have them if you want them. Here's our trading API, our regulatory team, our legal teams here. But it means there's more cost duplication.
Yep.
But there's more freedom.
Yeah.
And that's a good environment. What's maybe the answer to your question is that you look at your old business, Bet365, phenomenal business. It hasn't.
I wish it was my old business, but that's the one that I was affiliated with.
Yeah, but phenomenal business, but it's never had to transform its UX into something more modern. Some people are
well, it's the innovator's dilemma, right? I think changing things at some stage when you're that well established would disrupt so much existing revenue through change. It's hard to out-innovate yourself.
Exactly. If you look at it, if you're a brand new customer and you'd only played on crypto or free-to-play sites, or you're used to using Netflix, it's painful. But it's because of its market dominance, it hasn't had to. And there's always, we get lots of business plans going around the industry, as you probably seen as I do, for the next big thing on UX. Hasn't happened yet. So one of the oddest things.
Yeah, well, there's bits of it around the edges, as you say. Some of the crypto brands, I think, have done some really interesting things to UX and gamification. Some of them made possible by the lack of regulation in that space that has been a mitigating factor in some of the innovation. Yeah. Dampens a bit of the innovation when regulation constrains that.
True.
So maybe that's part of it. But I think there's also young entrepreneurs in those businesses that are bringing new ideas. Yeah. And maybe that's the seeds of what the new concepts and new ways of providing the product are coming from.
Absolutely. Yeah.
So shifting gears for a sec. So I imagine, we've talked about the early stage a bit. There's that growth stage that comes in sort of the middle of the journey where a business may have established and proven a product, maybe in one market. Maybe they've done really well building market share and establishing a brand in a market, but they now want to demonstrate that the model would work in different jurisdictions,
Yeah.
because that's also going to add value, that it's not, single value in this specific jurisdiction, but that
Exactly.
the product they've created would carry. So they maybe want to establish the brand in a new market that's going to require some capital, or they've found a niche and they want to grow the business to support the potential market of that product or of that service that they're providing, and it requires some capital. Is that's a difficult position for founders to navigate, about giving up equity if that's the way that the method of raising capital is through an equity issue. How would you advise a company at that stage? Is debt an option? Is there terms that they should be? Is there a vulnerable time to be raising money? How do you take a situation where you need the capital, but you've proven the fundamentals of the business and it's fuel in the tank that you're looking for? How do you navigate that with businesses?
So look, it's a great point, and it's a position that so many businesses get to. And I think in the different stages of the process, a different approach is required. I think when you start out, be very careful not to price too soon. You can use things rather than just going for a big, straightforward equity to start with. Look at other structures. So you can look at convertibles or safes, simple agreement for future equity. And what they do is you can set a structure where you get quick money, but you don't fix the valuation. And then what happens is when you do raise money, once you've proven yourself later, that investor basically comes in at a fixed discount to that raise, subject to a cap. But then also you'd be amazed what else you can do to raise money. You can also do revenue-based deals where you agree to pay someone a percentage of your revenue, so as the business expands, that they get more up to a fixed multiple of the amount they lent.
Off the top.
Yeah.
Okay.
So you might say, look, we're going to pay you 5% of our revenues until we've paid you 1.52 times what you lent us. There's also, you'd be amazed what you can do with suppliers. If the supplier really buys into what you're doing, you can sometimes get really, really strong delays on payments when you're in your establishment phase. If they're on side and they believe in what you're doing, and particularly if you've made some commitments around how you're going to use them. But as you get to mid stage, then there are options to think more broadly. I really, really advise entrepreneurs to think about on valuation. It's got to be based on things like your cohorts. You mentioned, Ashley, you've proven yourself in one market, prove yourself in another. You do not want to have opening the argument around your cash flow or even your revenues if you can help it. That's where the investors will go. They'll go on current and future revenues if you're not profitable. But you want to try and control the narrative. And you want to say, look at the cohorts we've created here in market X. Look at our cost of acquisition. Look at our ROAS, and here's our LTVs. And we've done that because, and underlined, whether it's product-led, marketing-led, brand-led, that's what you're looking to basically make them realize. And then tell them that you want to hold back the valuation until you've approved it in the second market, and try and eke your way there in that way. What you don't want to do is have the big second raise, third raise before you do that. Try and get yourself there without having a big valuation moment.
And the discount on deciding the valuation later aligns the interests of the investor with the founder, because then the investor wants nothing more than the business to continue that growth trajectory.
Yeah.
But agreeing to value the business later seems contrary to the interests of the investor that's having the conversation now.
Totally.
But the discount adjusts for that.
And absolutely right. And so, of course, debt's attractive if you can get it in any business because you don't dilute. But it's an extremely dangerous prospect in a market where we suffer from this sort of Damocles sword of regulation. And a good example of that at the moment, large scale, but it still applies at small mid, is Evoke's position at the moment. So 1.8 billion of debt. Interest payments in this year was expected to be around 180 million. Free cash flow this year was going to be 80 million. And that was after they'd done lots of cost cutting and so on. So that was going to be great. Although they've got this huge debt mountain, they'd managed to build the business to a point where they had good expected free cash flow, about 80 million sterling this year. With the introduction of these increased changes from our learned Chancellor taking this year, it's basically wiped out all of that free cash flow.
Right.
for a vote this year. And so this,
And all that free cash flow was derived from the UK market?
they're not, but it's not
The
only,
impact is,
but it's predominantly UK oriented business still. They've done great things to try and diversify, but it's very heavily UK oriented. And so that's the problem. Their leverage is what? Debt to EBITDA is sort of going to around about 5 times. It's very dangerous in a market like ours when you start getting above, everyone's different, but where there's real regulatory uncertainty, having more debt than your, in terms of your debt to EBITDA, once you get over 2.5 times, it's quite dangerous territory, because when things go wrong with the equity investors, you fall out and they're disappointed. When things go wrong with your lenders and you breach your covenants, they can come in and take over the company. So,
how do you combat low valuations when you're vulnerable?
yeah, it's a thing that happens, right? When you're in a position where maybe you've got good prospects, but right now you can't prove them. I think then again, it's about ensuring that you're portraying the business in the right light and you're proving the elements that count. So I talked before about scarcity. What investors want to see is that what you're doing is that it's defendable, that there's a moat, that there's barriers to entry. You're wanting to prove that you've got a head start on anyone else coming towards you, and that the initial signs of what you're doing are very positive. And you've got to basically update the investors regularly on that. You've got to keep the communication very strong. And if you can do that, if you can keep the narrative focused on those areas and away from some of the bigger headline points, like, your overall revenue that last month wasn't great, or, you want to keep it focused on that. That is the best way to do it. And you've got to find those alternative ways of raising funding that I've mentioned, and try and delay a big valuation moment until you've hit it. Sounds obvious, but that's the way that the really best people do it.
When do you advise a business to consider M&A as a method of growth versus just marketing and more customer acquisition?
When businesses are thinking about growing, you and I in our businesses, it's, for most companies, it's pretty straightforward to grow the business if you're sticking with the existing business model and you're doing it in nearshore. When you'll start thinking about bridging different continents and entering different verticals, a lot of people think that's going to massively distract my management team. And that is a point when M&A becomes a real option, because M&A can give you a team, it can give you local knowledge, relationship with regulators, good marketing, maybe even a brand, but it gives you that infrastructure and hopefully some existing cash flows. Now, a lot of businesses can go a long way without doing M&A. And one of the great examples is Betano Kaizen. And they're now, if you look at OPAP, reports, they're now a 2.5 billion euro revenue business, and they've gone from being, I think, in 7 markets in 2022 to now in 18. Phenomenal. And they've done that without any M&A. In fact, the only M&A they've done is for a really smart piece of B2B technology to help them in their trading arm, which my colleagues at TechCore actually did. That's the only bit of M&A they've done. So it can be done, but I would say they are quite a unique example. And in most cases, when businesses are thinking about how to grow in those areas I mentioned, different continents, maybe far shore, medium shore, and new verticals, M&A is a really important thing to consider. And one of the examples I've mentioned, and there are many more, but you look at the success story of Paddy Power going to Flutter. It can be an incredible route to kind of build value and grow market dominance. So I would always compare it in those circumstances, your M&A options on new market entry, new vertical entry, with the organic approach.
But what are the risks? What can go wrong? Because you set it out as though it's, why isn't everybody doing it?
Yeah.
But I suppose that road is paved with tombstones of deals that fell apart.
Yeah.
And there's all sorts of, because it's a big people business, what we do too. And there has to be chemistry between the acquired company's management team that you're trying to gain the value of that additional, management capacity through the acquisition of it, as well as the synergies that you're looking to unlock.
Yeah, exactly. So there are many pitfalls. Funnily enough, the pitfall that most CEOs and investors worry about is overpaying. And funnily enough, that's not usually, although it can sometimes be the issue. Often you see deals get really stretched about whether the buyer or seller is getting 10% more, 20% more than the other person thinks worth it. Actually, that's not usually what goes wrong. Now, of course, there are extreme examples. There's Penn buying the score, and making some crazy, well, not crazy assumptions. I mean, hindsight's a great thing, but in hindsight, crazy. At the time, they had their reasons, but they made some assumptions about converting the score's user base, which weren't based on reality, and they ended up massive overpaying. But usually, when you look back on deals that have gone wrong, it's not price. And actually, there are a few things that do come up regularly that are the main pitfalls for buyers. Number one is having a really clear strategic vision about why you're doing the acquisition and communicating that to your team and the incoming team unbelievably clearly. Where people don't understand why the acquisition is happening, it's a huge driver of things going wrong. And that brings me to my second point, which is it's usually always about people. People coming in and people are staying, whether you're doing centralized or decentralized, whether there's a big headcount cost cut or not. When people don't understand what's happening, they don't understand their role in it, and they think there's duplication, and they don't feel motivated, and they don't feel there's any reason for staying, you've got real problems. There's a great quote from Jeff Bezos, which is basically talks about the cost of coordination. I'm sure you've heard of this. So it's really interesting. My brother worked at Amazon for a while, and he
there's a lot of Amazon and Jeff Bezos learnings to go to. So,
and I really like this. He's got this rule about once a team gets bigger, then you can feed it with 2 pizzas.
Yeah, right.
We've got problems.
Or a meeting. Yeah,
because the cost of coordination in his book is as teams grow in size, you get this tax on growth, which is effectively more meetings, more information flow, more people involved, and then slower decisions. And when you're integrating 2 companies, whether it's a small company buying an even smaller or a mega merger, whatever it is, you need to think really carefully about how you're going to avoid that. And some of the best examples on acquisition have been where they've said, we're going to buy you, but we're not going to try and exact the maximum possible amount of cost synergies here. Our investors would love to hear that, but we think they're going to kill the business.
Right.
And it's about ensuring that the key people who have really created that nuance and that entrepreneurial flair in the company you're buying stay in the business, keep doing their magic, and keep producing for you. And it's hard enough as it is because, as you know, one of the real drivers of a founder's entrepreneurial spirit is the fact they own a big equity stake. Once they've given that up and they've been paid quite a lot of money, funnily enough, their ambition and creative zeal can drop. And that's why we're seeing longer and longer buyout periods, because the investors are getting smart. They're saying, look, we love you. We love what you're doing here, but we're terrified. We'll buy you 100%. You do 1 year and then you're off. And now we're seeing deals where they're being kept in for 3 years, 5 years, even longer.
Would that become something that if there's 2 suitors for a deal, they would compete over the earn-out?
That's a great one. Yeah, it can be really valuable, that. And it depends. You do get some founders that just think, oh, I'm done. And that's never a good sign. You want to be buying a business, and a founder wants to be selling a business where they still really love it, and they want to show the new buyer and the new owner that they're going to help accelerate it.
I get that, but there's also sometimes 2 different types of founders: those that want to build things, and then those that are good at operating them and extracting the most efficiency out of the business, or extracting value. And so I can understand the mindset of a founder that says, if I build any more, I'm at risk of breaking something that's working very well. This now needs to be in the hands of somebody who can run it and take it to new markets. And it might be a different mindset. Yeah. Do you think? Or would that
No, I totally agree. That there's was it finders, minders, binders, and
there you go.
grinders. But I agree with that. But if you're a buyer and you're spending, whether it's 50 million or $1 billion buying a business, and the key 2 or 3 people who have generated the growth
are out the door,
it's your job. You need to have the HR teams involved, like not on day 1 but on day 5 of the discussions, because you need to understand exactly that point. If these are guys that are just going to go off the boil, is this really an acquisition you want to make? And if they are going off the boil, how can you restructure things? What can you create for them? Is there another area that the business wants to expand in that these guys could help deliver? You need to find a way to deploy them. and keep them engaged in a way that works for everybody. Otherwise, it's so risky.
So where do you see the opportunities in today's market? What are the most attractive potential deals to be done in this industry?
So I think in B2C, in terms of geography, I think, again, investors are looking at markets where they're regulating or about to regulate, because the biggest growth is in the first 5 years, right? So they want high growth regulated, so on the cusp. They want reasonable tax rate, not UK. They want like 25% of GGR, that kind of area. And they want a market where they think they could compete, and which is going to get to scale. Like, people don't want to be buying into markets that are going to be less than $100 million total, like 3-4 years time. So it needs scale, it needs growth, and it needs fairness on tax. And some of those that fulfill that criteria at the moment are Finland, super interesting territory. A lot of people looking at it. License applications happening now, going to go live next year. There are some existing incumbents in Finland, even though it's not regulated yet, coming off an Estonia license. So there are people looking in the market to buy businesses that have Finnish customer bases.
Yep.
Even though there's no Finnish license, because they're taking what we talked about earlier. They're taking a view. Other ones, New Zealand's quite interesting. They've got a cap on licenses of 15 only licenses, and it's for casino only, not like Finland, but very attractive. There's two that got real option value that I think are worth mentioning, which people forget about, is France and Poland. France has been sportsbook for ages, really high tax, no M&A there. There's been tiny bits of M&A because the tax rates are so high. It's a bit of a turn off for most buyers. If they regulate casino, it's going to be absolutely massive. And there's more and more talk of that. Similarly, Poland, there's nothing set, nothing written down, but if that introduced casino, it would be massive. So those
But Africa.
Yeah, so Africa is super interesting, but it's currently falling, in my view, between two stools. We have a great guy on the TechCore team who specializes in Africa, and he's much better at talking to us than I am. The key to Africa is finding the middle ground between very early stage businesses that are very unstructured and difficult to audit, hard to know what you're buying, and they may have a license of initial relationships, but you don't have quite enough. And the kind of big, much larger, more established businesses that are asking for huge valuations. There aren't many in the 25 to 100 million area. That kind of mid-stage business with good, strong, proven management teams in stable regulatory markets. So markets like Sub-Saharan Africa, there are 5 or 6 interesting regulated countries there. Kenya's still very interesting. If you can stomach the volatility on the regulation and you can find a team, I think it's very interesting.
And what about Canada? Alberta market is opening up, so there's a second licensable jurisdiction in Canada.
I mean, Canada's one of the great success stories look at what's happened in Ontario.
Yeah.
It's done much better than people would have thought.
Yeah, there's even businesses that establish themselves just for the Ontario market.
Totally.
That are very attractive businesses today.
Yeah, I mean, you saw the deal. Betson just bought into that market. They bought Casino Days, the Rhino Entertainment brand for Canada. Yeah. And and I think that's a really exciting market. You're right to add that to my list. Actually, Ontario is definitely one of them.
So, Crispin, with the changes that have happened with the gaming tax in the UK, what do you think happens next in that market? Do the companies that are in stay in and navigate it with diminished margins and diversify outside the UK if they're not already? Does anyone enter the market now? What do you think?
It's a very, very tough environment. I think it's because it's such a huge impact on margins. I think there's a few things that are going to happen. One, we're already seeing this, small, medium-sized players who don't have the scale to make it work, or those skinny margins, they're going to either try and sell or they're going to close. If they haven't already converted to new markets, it's very tough to do that in a hurry. Now they may be able to sell themselves, on an asset basis rather than a going concern. Maybe they've got a great bit of technology, great PAM, maybe got great sort of marketing assets. There are different ways to approach it, but we're already seeing that, and we're seeing some sort of people circling saying, if you come across people that are right, who are kind of bailing out, we want in, but only at a really low price. So
Right, vultures.
the vultures are circling. But at the mid to high level, look, it's very tough. But when you look at markets like France, who have had very high tax for years, what you tend to see is that only the really large scale players can survive, and they can actually build good scale businesses. It's just the market will have to get used to much lower profitability, and as a result, the revenue multiple is going to be seismically different.
So if you were going back to putting your entrepreneurial hat on, you were
Yeah.
going to start a business today to build value in 5 years' time, what would you do?
So I think one of the really interesting areas is coming back to businesses that target more recreational customers.
Okay.
I think what we're seeing in the UK, Denmark, Sweden, Europe in general is going to spread. I think state control or state involvement in things like affordability and state limits is going to spread. And I think with that, the business model where people are just focusing mainly on VIPs and having too much concentration risk, I think that's going to become less and less appealing. I think the really interesting area is in more recreational business models where they're on the where they bridge real money gaming, but very recreational. So low stakes, high retention, and repeat play. Maybe they're playing like once a week, not 5 times a day. Those type of products. Traditionally, they've been more around bingo, but people are doing more and more to bring those into more casino products like slots. Introducing more mini games, bringing down the thresholds of the volatility, making it more frequent small win. And there's some really interesting businesses out there doing that. And so that's the area. And what we haven't seen yet, and I think if it happens, will be fascinating, is if we see no one yet has basically managed to bridge that. There's no one out there offering a free-to-play social product that's also real money at scale and proven it, and is taking customers safely into a real money experience and then back out into a free-to-play experience. So that's the area where I think there's real longevity. And maybe the fact no one's done it proves it's going to be impossible, but I think it's something that people should look at more.
What are we doing here? Let's get started.
Let's do it.
Okay, so thinking about companies that are trying to sustain their growth, that are already at scale, trying to sustain double-digit growth,
Yeah.
they may look to emerging market products like sweepstakes or predictive market
Yeah.
platforms.
Yeah.
Is there a there for those businesses? Is that a smart move? Would you advise them to?
Yeah, I think it's very tough now because I think the era of easy growth is over.
Yeah.
It used to be you could get 10% growth in European regulated markets pretty easily. Now I think most people, you could look at this year, 6%. So you if you want to get the alpha, if you want to get 10% plus, you either have to go to emerging markets or you have to go to some of these disruptors, some of these more innovative models. And you're right, you mentioned a few. Predictive markets, definitely one. See what High Roller's done with their deal with Crypto.com. Then there's DFS 2.0, which is basically allowing DFS players to do a kind of RNG bet on player props. Then you've got sweepstakes, so social casino with sweepstakes. And then the last one that's quite interesting is just basically gaining more momentum is around horse racing or motor racing being used as the RNG for casino.
Wasn't there UBet in California years ago that was doing
Exactly.
slots that were decided on the outcome of a random
Exactly.
racing event? Is that what you're talking
Yeah,
about?
yeah, exactly.
So that's still
That's it. So that's
making a resurgence?
that's getting some momentum because what I love about the US is that that there is this uncertainty on how the gambling regulation is going to evolve. You just don't know where you stand. All the way back to when I was doing my poker business with UIGA, there was this gap, wasn't there, between when they banned online poker and then they did anything about Full Tilt and Stars.
Yeah.
Actually, and they came knocking eventually, but in the meantime, they built billion-dollar businesses. Similarly, now we have this regulated sports betting market and very, very few regulated online casino market. Predictions coming in, social casino with sweepstakes is coming in. And
Well, it was daily fantasy sports betting before, and those companies transitioned market by market into regulated sports betting.
And I think, everyone's waiting and seeing. Will there be a seismic event where maybe there's one big legal event where one of the main players is taken on by one of the incumbents?
Right.
And it's very hard to call. And once that type of event happens, whether it's in social casino with sweepstakes, or maybe whether it's in motor racing driven betting, once that happens, then I think investors can come in. At the moment, there's too much uncertainty about which way it's going to go. But again, is someone going to follow the state model? Is one of these people from the unregulated going to move into the regulators, or vice versa? It's one thing about the US is just so unpredictable
right now. Yeah.
Yeah.
So looking at the market in the last few years, is there a brilliant deal that you think was the absolute marriage made in heaven? And maybe is there an opposite end of the spectrum? Is there a deal that you think was misjudged?
I think my favorite deal is the Paddy Power Betfair acquisition of a majority stake in FanDuel. And I think they paid cash like $158 million. They also put their US business in, and they got, from memory, 58% of the business, and now it's worth tens of billions. There's a masterful piece of M&A. On the flip side, I mean, there's lots of good things about that, but they really knew what they were doing. On the flip side of that, again, I always feel bad about, but I suppose, yeah, Penn with Barstool.
Again, like you said, benefit of hindsight.
Yeah, I mean, they had it with the school, but with Barstool, they bought it, and then they ended up selling it back 3-4 years later for $1. And again, it was because they made assumptions about the ability to convert that audience and utilize that brand to build gambling customers, and actually the conversion just wasn't there. So I think, when you're making assumptions as a buyer about how you're going to grow this business, you need to really, really have very, very strong evidence about why it's going to change anything above the current run rate, because it's usually what comes and bites you.
I had another question for you, but I mean, and having had this conversation now, I can only think of the positives we've discussed for the many reasons why M&A makes sense for both sides of the equation.
Yeah.
Right? I was going to ask you, is M&A a force for good or a force for bad? I haven't seen the downside of it. I guess you talked about it can distract or disrupt an organization that has a good chemistry.
Yeah.
And that suddenly you add another management team, you
Yeah.
add another jurisdiction, you bite off more than you can chew, or you distract the management team. Are those the pitfalls?
Totally. I think you put your finger on it. I mean, I'll take some examples. If you look at what's happened to Sky Bet, since it went under sort of the Flutter umbrella, it's accelerated. It's become a fantastic business. So I think it's less about the fact that it's been acquired. It really comes down to the acquirer's management team and how they decide to utilize that asset and how they deploy those people, because you can get some real painful scenarios where people do head out. We mentioned Penn with Barstool. I mean, actually, that worked out very well for the Barstool shareholders, right? But for Penn and the Penn shareholders, it was a disaster. But it's very, very important when you're making that acquisition that you're thinking very hard about how that team is going to be incentivized, just as it has been in the past. Okay, different dynamics. They don't own 40% of the business anymore, but they need something just as important that's going to make them think 24/7 about how to grow the business. And without that, it's very hard. Taking that example of Sky Bet, I know they did a brilliant job just letting the Sky Bet culture continue. It was, quite a sort of tight culture, all sort of based in and around Leeds, not very international. And the rest of that broader group, very international with like Stars and so forth. But they allowed that business and they sort of cherished its culture, and that was really important to letting it grow. So I think it can be a real force for real good if done right. Obviously, maybe it's sort of a bit of an obvious answer, but you need to basically work out what's magic about the company you're buying and allow that to continue.
So at TechCorp, when you advise companies either on the buy side or the sell side, are you involved only in the transaction, or do you discuss with them and support them through the, like you said, having clear vision, having a clear objective, not just having, we've seen companies in this industry that it seems as though the leadership teams get addicted to the next deal.
Yeah.
And that becomes the objective, is to do another deal rather than maybe scrutinizing the strategic value as much as you did the first deal.
Yeah.
And so, before the transaction, defining a strategy and setting it out and making sure you're focused and identifying targets that are aligned with that strategy, and then betting it down after the transaction happens. Do you support throughout?
Yeah, that's actually how we prefer to work. It just doesn't work if we're brought in just to do the transaction. What's different about the team at TechCore is we've all been operators. So I ran my own startup. I also was MD at William Hill Online. All of the partners, they've all had MD roles or FD roles at big online gambling companies. So we're not just bankers or ex-bankers, rather. And so actually, that's the bit we prefer. We're very happy to spend time with companies without it being of any significant cost to them for potentially quite a long period building up to when a transaction might happen, because it's interesting for us. We learn stuff, they learn from us, and we can also help direct them, and it also builds the relationship. Because when you get into a transaction, or you get into getting close to a transaction, for founders it can become quite pressurized. They're running their core business, their baby's up for sale. People are usually saying some nice things about it, but also some, challenging things about it. And having a good relationship with your advisors at that point, who really understand it, it can be a real game changer, actually.
Yeah, it's like a Sherpa that's climbed a mountain that you're about to do the first time.
Exactly.
Having somebody along with you that says, "Don't worry, the base camp's coming up.
Yeah,
take oxygen for the next climb. You're going to need it."
Exactly. And look, we're not. It's very important to, when a business isn't ready, it's not ready.
Yeah,
it's very important for us that we only present things to buyers when we think it's absolutely nailed on, and because otherwise it's a waste of the seller's time, the buyer's time. It's just not worth it. So it's about sometimes you have to evolve the business quite a bit before you get there. We've had that many times.
Well, Crispin, we at Pragmatic Solutions, we work with operators of various different scales and different stages in their journey.
Yeah.
Medium-sized operators up to enterprise scale. Rhino, as you mentioned earlier, it has recently gone through a transaction. We also work with High Roller that you mentioned earlier.
Yeah.
I think this is a really interesting discussion, and what the services that you provide is instrumental. It's critical to the way businesses grow and navigate today's market. We've said on how it's strategically important that companies consider M&A as a strategy for growth. For entrepreneurs that build something, they want to extract that maximum value at the right time and navigate through the vulnerable midpoint if one comes along. So I think this is a really interesting discussion, and I thank you for joining me for it. And as two guys who've been through the entrepreneur journey, it's exciting that this industry has so much activity, and there's so much opportunity inside of it. So
definitely,
thank you for joining me to talk.
Thanks a lot, Ashley. Yeah, I really enjoyed it.
Really good talking.
Thanks a lot.